Hello, everyone, and welcome to today's session. I am Diane Compardo, the founding partner of the Compardo Weinstrower Conrad Janes team. Joining me today is Lauren Randazzo, our team income tax expert, and Ben Trujillo, our team estate tax expert. Welcome to both of you.
Good morning,
Thank you, Diane.
Today's webinar is going to address potential changes in the income and estate tax laws that might come into play with our new administration. All of the topics being discussed today are taken from statements made by the Biden campaign, from Biden himself, and from leading Democrats. We will start with a general overview of expectations, and then we will dig a bit deeper into some of the specific topics that President Biden discussed during the election process and that continue to be part of his platform. And throughout our discussion, we will be providing some specific examples of how these provisions can impact you. With that said, Ben, let's start with you on some general thoughts on what we can expect.
Thanks, Diane. I think what we can expect, given what the campaign said during the presidential election and what we've seen since Joe Biden took office, is increasing taxes on the wealthy. So I expect targeted tax increases in the form of increased tax rates, as well as additional taxes on capital gains, some new payroll taxes, and probably a large increase on the corporate income tax. I think we can also expect an increase in the estate tax as well. I think one of the things we do need to also think about is retroactivity. And when it comes to retroactivity, historically, retroactivity is a thing. It has happened in the past. Typically, it has happened, retroactivity has happened when tax rates have gone down more than it has happened when tax rates have gone up. But it can happen both ways. I think the likelihood of retroactivity at the beginning of 2021 is relatively low, probably more likely with income taxes than with estate taxes. But I think if I were going to place bets on things, I would bet on everything starting around January 1st of 2022.
Great. And Lauren, when do you think we can expect them to start talking about these changes in detail?
Well, Diane, I think that they've already actually started talking about many of the changes. We had the American Rescue Plan Act passed last Thursday, and with that, there were many of these provisions already kind of lumped in there. Now, the major ones that we're going to be focused on, the tax rates, those weren't included, but I think that will be discussed heavily come the fourth quarter. So October, November, December, most likely with some rush legislation passed at year end before 2022 kicks off.
Great. So why don't we jump in and just talk a little bit about some of the things we can expect on the income tax side. Lauren, I'll let you take the lead on that and just talk broadly about some of those changes.
Perfect. Thanks, Diane. One of the main ones, and Ben alluded to this already, is increased tax rates. So the ordinary income tax rate, currently the highest rate is 37%. And that kicks in for a married filing joint couple when their taxable income is over $600,000. A single tax filer with taxable income over $500,000. So with the Biden proposal, they're talking about this kicking in the highest tax rate, not only increasing from 37% to 39.6%, but also kicking in with a taxable income of $400,000. Now, if that's the case, there's going to be a significant marriage penalty there because we're going to see that, on that highest tax rate on both sides. So it'll be interesting to see how that plays out with the legislation that they're looking to pass.
Great. And I also know they were talking a lot about the capital gain rate changes. Shall we talk a little bit about that?
Oh, yes. With the capital gains, currently we have the highest tax long-term capital gain and qualified dividend income tax rate of 20%. They're talking about making that the ordinary income tax rate for people with income over $1 million. So that's going to be a huge discrepancy. We're talking about a 19.6% tax rate increase. Now, some unknowns there. We don't know when that $1 million is going to kick in. Is it going to be adjusted gross income? Is it going to be taxable income? How are they going to put that in place would be the main question.
Great. And Ben, I know they're also talking about capital gains changes on the estate side, which maybe we'll address that a little bit here, but dig in deeper later.
That's right, Diane. We'll talk about this in depth when we get to the estate tax portion of our presentation. But it is worth noting that right now everyone gets a step up in basis if they hold on to an asset until they die, which means the heirs will inherit it and not have to pay capital gains tax on much of it, because when they sell it, they'll have a stepped up basis to the fair market value at the date of the original owner's death. If that goes away, we would see a very large increase in the estate tax, essentially, because you would now have an estate that would have to pay income tax that it did not ordinarily have to pay. But we'll talk about that a little bit more later.
Right. And I think these two changes actually work together in a sense, because if we're deciding on whether to recognize gain, many cases we would hold off and recognize in a big, massive gain if someone's closer to an estate tax situation. And in this case, if that basis goes up, there won't be any reason to do that anymore. And we'll be looking at, should we go ahead and recognize it now? So I think one of our planning discussions we're having with clients is recognizing gains in the current year before these changes take place. Lauren, do you have any comments on that?
I think that it's definitely something that's on the top of our mind. And I think in every discussion with our clients, really what we're going to try to do is see, okay, it's going to be a case by case situation, and we're going to have to look in depth at their, not only their income tax planning needs, but their estate planning tax needs as well. I don't think we would never make a blanket decision for all clients, but definitely something that we're going to address case by case.
Right, and keeping that income level below $1 million and maybe managing the gains to that level.
Mm-hmm. Great
One
point,
of the
Diane.
other, yes, and one of the other, I know, big changes that they're talking about is Social Security tax expansion. Lauren, do you want to jump into that and give us an overview of what's going on there?
Yes. So currently we have, we all refer to it as FICA tax. It's that 6.2% Social Security tax that we pay. As a self-employed, we pay 6.2% as employees. Employer pays 6.2%. Self-employed individuals pay both portions of that. Now, currently that caps out with an income of $142,800 for 2021. And then you don't pay any more Social Security tax or FICA, however you want to refer to it, the 6.2%, but you don't pay that anymore. They're talking about bringing that back as soon as somebody's compensation reaches $400,000. So there's going to be a gap from that $142,800 to the $400,000, and then it's going to kick back in again, which will have a significant impact on all taxpayers with higher incomes. All self-employed individuals who pay Social Security tax or have incomes over $400,000. So it'll be interesting to see. Also, we don't know how that's going to move going forward. Many thoughts are they're going to keep increasing that $142,800 on an annual basis like they do currently, but keep the 400,000 level the same. And they kind of are referring to it as the donut hole effect. So basically closing that gap, and then all income will eventually be subject to FICA or Social Security or that 6.2%. So it'll be really interested to see how that's going to be enacted if it passes.
Great. So that's a pretty big differential on what a current employee is paying. If they make over 400,000, they can expect a 6.2% increase. And if you're self-employed, it's a 12.4% differential on anything over 400,000. So a pretty substantial change in that tax law.
Mm-hmm.
What about stock-based compensation as it relates to the Social Security tax?
Well, this could be a very effective tool, and we'll probably see employers really utilizing this even more so. So incentive stock options don't actually have to pay FICA tax as long as it's a qualifying disposition. So we might hear those incentive stock options or ISOs becoming more back in vogue. We're seeing it a lot with startup companies, but we might see that even more beneficial for companies and really their employees. Also, non-qualified stock options are still beneficial because there's a timing aspect of it. Typically, you have 10 years from grant to exercise, so we can see people timing their income more to really stay under that 400,000 and make sure that they're not getting hit with it again or hit with more Social Security. So it'll be interesting to see.
Great. Just additional planning ideas there in terms of controlling income to the extent we can, which you can do with any kind of incentive stock options and non-qualified stock options.
Mm-hmm.
What about the changes in some of the deductions?
Okay, so we're going to see quite a few changes from what's being proposed. One of the big ones, especially in the high state income tax rates, is the removal of the state and local income tax deduction limitation. So currently with the Tax Cuts and Jobs Act that was passed in December 2017, we are now capped at $10,000 for the state and local tax deduction. They're talking about removing that. Now, there are other implications when it gets into alternative minimum tax surrounding that, but I won't bore you with those details today. So we'll have to wait and see how that plays out. Also, they're discussing an itemized deduction cap, so a total benefit max benefit of 28%. So that's something new that, it'll basically they'll be reducing your itemized deductions to ensure you don't get more than a 28% tax benefit there. Another item for basically a limitation from the itemized deductions is they're discussing bringing back the PEAS limitation. And what the PEAS limitation is, it is a reduction. Once your income reaches a certain level, it is a reduction of your itemized deductions. So we're reducing your itemized deductions by 3% as soon as your income surpasses a certain level. Whenever the PEAS limitation was enacted before, it was in 2017, it was about $300,000 where that would start kicking in. So many limitations on the deduction side. Also, though, a benefit of bringing back that state and local tax deduction for the full benefit there.
Great. So we're seeing the tax rates on the highest end go to 39.6, but the cap on the deductions being 28% benefit, which is a pretty substantial change and hurts those people with big deductions on a long term. Great. And I know one of the big things under the Tax Cut and Jobs Act was the qualified business income deduction that came into play. Do you want to speak a little bit about that?
Yeah, so that's due to sunset with most of the Tax Cuts and Jobs Act provisions in 2025. But the qualified business income deduction, a lot of people refer to it as Section 199A. That deduction is set to get phased out. They're talking about phasing it out sooner. So we're not exactly sure how they're going to do that, but that is a discussion that they want to phase that out with lower income individuals can still receive the benefit, but higher income individuals will not, or taxpayers.
Great. And then what about some additional tax credits that we're seeing out there today?
Thank you, Diane. Now, this is something that we've already seen a lot of the Biden administration kind of pushing through with the American Rescue Plan Act. So we saw them make changes to the dependent care credit, raise the child tax credit, make changes to the earned income credit. So those are all things that they've already started working on and enacted through this past legislation. There's other items that they're talking about too, instilling a new renewable energy tax credit, a first-time home buyer credit. So a lot of beneficial credits for lower income individuals.
Great. Well, good. I know there's a lot to cover there. We won't go into depth on that. So those are just a high-level summary of some of the credits that are out there. Let's pivot a little bit and jump into the estate side. And Ben, I'd let you take the lead on here and maybe talk a little bit about the state tax changes generally that we might anticipate.
You bet, Diane. I think that we are looking at potentially the largest change to the estate tax as long as I've been practicing, and that's about 24 years. So a lot of changes coming. Three major changes to hit on. The first would be the change in the exemption. So right now, the current exemption is $11,700,000 per individual. So a married couple can transfer almost $24 million before the imposition of any estate or gift tax. The Biden administration is talking about reducing that to historic levels. Historically, that's been anywhere from $675,000 all the way up to what it is right now of $11,700,000. I think what we're looking at in terms of the likeliest outcome is a $3 million to $5 million exemption per person, probably $3.5 million. So we can expect a married couple to be able to transfer about $7 million before the imposition of any tax. The second major change is the estate tax rate. So we're going to see the estate tax rate increase from 40% to 45%. And then the third major change is with respect to the basis step up, which we touched on earlier, and that is the loss of a step up in basis for taxpayers who pass away owning assets. So those are the three major changes that we can expect.
Great. And I know they've grandfathered in some information around these exemptions. Do you want to talk about that and then maybe give an example of how this is going to be so impactful if they do change this?
Absolutely. So right now, the exemption is 11,700,000. So what we will try to do for our clients is to use that exemption before it's gone. The IRS has ruled that if you use the exemption and the exemption then goes down, you don't lose it. You don't have to go back and pay tax on what you've already transferred, which makes logical sense. This came up back in 2012 when there was a chance that the exemption was going to drop. It's fundamentally a change in the way historically the estate tax has worked. As long as the estate tax has been around, the exemption has only gone up. It has never gone down. So no one really understands how to treat that. But we at least finally have some rulings from the IRS on what they expect to do. So we would encourage our clients to use up their exemption as much as possible without adversely impacting their cash flow. So let's take an example of a person who gifted $5 million in 2020. They'd only be grandfathering $1,500,000 of exemption if the new exemption is $3,500,000. So they would have given up $6.7 million of exemption. So we're going to encourage everyone to use up as much of the 11.7 million as they can, because if it then drops to 3.5 million, they've saved $8.2 million in exemption, which translates to almost $4 million in taxes. So it is a major concept that people need to be comfortable with and thinking about ways to do that. And there are a variety of options out there to achieve that, one of which is the use of spousal lifetime access trusts. And we've been doing that for several of our clients, funding spousal lifetime access trusts, using up exemption and grandfathering in these high exemptions right now.
Great. And how does when we think about the capital gain element of this, how does that play into this whole discussion around the estate tax?
Well, with the exemptions being as high as they've been, estate planning wasn't something that we had to do for every client. When the exemption was $675,000, we did estate planning for a lot more people than we do now. When the exemption was $675,000, it affected about 7% of the population. With the exemption at $11,700,000, that affects about 0.2% of the population. So instead of planning for estate taxes, we did a lot of planning for income taxes. And the way we did that is we planned to hold assets that had high built-in gains until death, so that we get a step up. That way, we wouldn't have to pay income tax on those values. Now, with the step up potentially going away, we're going to pivot now to planning for estate taxes, less planning for income taxes, at least at death. Instead, we'll have to think about recognizing gains during life and reducing the estate. Another question that comes up is if the exemption or the step up is such that we lose it altogether, how is that going to affect the value of the estate? Is the estate going to be the full value before you pay taxes, or are you going to get a credit for taxes that are due to the step up? Is death going to trigger the step up? We just don't know. Does death suddenly become a taxable event when it comes to your capital gains? It never has been, but in Canada, that's how it works. So maybe we'll see that here in the United States. It's a real question mark, and it's really going to affect our thinking. For example, if you have a family farm and you have a massive increase in value over the lifetime that farm has been owned, think about it, these have passed down for generations. The basis in those farms could be zero and suddenly worth tens of millions of dollars that they now have to pay capital gains on. Are they going to have to pay that all at once? This could be very bad news for small business owners. Mm-hmm. Are we going to see something like 6166 election that allows them to pay the tax over time? Or maybe the heirs are just going to inherit the basis and then not have to pay tax until they sell it. But there's so many questions here. We won't really know the best way to plan until we get the answers, but we've got it all lined up and we're thinking about all the considerations that we need to at this point.
Right. So still a lot of moving parts and not really anything firm enough for us to give great guidance, but we'll be watching very closely. Why don't we talk a little bit about just the legislative process and the changes that can take place and how they take place?
So I think Diane, we should just talk about what the current situation is, right? Right now, we have the Democrats in control of the House of Representatives, the Senate, as well as the White House. But the control in the Senate is split 50-50, with Vice President Kamala Harris casting the tie-breaking vote when necessary. The Senate has what's called the filibuster, and that's just a rule of how things are done in the Senate, where if you want to pass legislation, generally you need to have at least 60 senators on board to kind of force that legislation from the discussion on the floor out to a vote. With Congress split the way it is, it seems unlikely that we're going to see many traditional, filibuster-proof passages of legislation, at least for anything controversial. And I think taxes fall into that category of controversial. So there are ways to pass legislation without the filibuster, and we just solved that with the COVID relief bill, and that is by using budget reconciliation. And budget reconciliation allows legislation to pass through the Senate in very particular ways with just a 50-50 vote, with the vice president casting the tie-breaking vote, which is exactly what happened. So we just passed $1.9 trillion of stimulus through this process. The thing about budget reconciliation is that you can only do it a few times before you have to wait and before you can process it again. And I think there's no set rule in terms of exactly how quickly you can do it, but a good rule of thumb is you can probably get away with budget reconciliation 3 times every 2 years. And I think that if we have major tax legislation, it seems likely that that's going to have to pass through budget reconciliation. And I think the soonest they'll even be able to start talking about it is mid to late October of this year. So I think we have a little breathing room when it comes to tax reform. I think that there might be some discussion sooner rather than later, but I don't think there'll be actually any progress until they do it under budget reconciliation. And as Lauren said earlier, I think that they'll probably just squeak this through at the end of 2021.
Right. And then we're still thinking, though, even if it does get through, that most of these changes, since they will likely be tax increases, we'll hopefully see them be effective for the beginning of 2022 then.
I think you're absolutely right.
Yeah. Well, great. Good conversation, good discussion. Thank you, everyone, for joining us today. We had a lot that we talked about and topics that we covered very broadly. If you have any specific questions after listening to our webinar, please reach out to any one of us personally. Our contact information is on the screen in front of you right now. Thank you for joining us.
Thanks, Diane.
Diane.
Thank you both.